Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, December 31st, the last day of a year that has been fantastic for some and much less so for the others. So here we are, guys, the last day of the year and the last trading day of the year. It's now been about 2 years that ChatGPT was launched, and it's been about 2 years that the AI buzz pushed some big US technology companies to the sky, really. Nvidia, for example, which has become the icon of the AI rally, gained almost 1,000% since the beginning of this rally. The Magnificent Seven stocks nearly 100% since last November, and the S&P 500, where the market cap of the big technologies stand for about a third of the total market cap, is set to close the year with a 25% advance, and that after a similar advance the year before. So at the start of this year, the big technology rally was expected to broaden toward the other sectors, the non-technology sectors, which it did, but it didn't really prevent the Magnificent Seven stocks from contributing to the much of the S&P 500's performance this year, because the rest was quite flat. Really, the equal weight index actually played catch up throughout this year with the normal weighted technology heavy S&P 500, but investors have started giving in since the beginning of this December, where we started seeing the big technology appetite take over. Apple, for example, which remained pretty much on the back foot with this AI rally and AI progress and couldn't do much on that platform just yet, rallied 33% this year and has fallen just 5 sessions since the beginning of this month. Just 5 sessions. Now, unfortunately, the last few days, the last few sessions of trading, even the tech appetite was very, very weak. So we saw no year-end rally really like the ones that we love to watch. On the contrary, yesterday, the S&P 500 lost more than 1% for the second straight session, and the Magnificent Seven stocks were actually to blame because together they gave back 2%. Now, of course, as we've been talking about it, this week the trading volumes are abnormally low because everyone, or almost everyone, is on holiday this week, and the slightest moves that we see in the market lead to some exaggerated price action. But on the other hand, it is also quite normal for everyone to start thinking that the AI rally will one day fizzle out, or at least we will see some correction or maybe a sizable correction, given that the valuations, especially for the big technology stocks, went so high, and the expectations today have become very difficult to satisfy. But still, all of those who called for a correction this year happen to be wrong, and Wall Street analysts actually spend their year raising their price targets for the S&P 500 because already by late January this year, well, the S&P 500 had already cleared the average price targets across the board. So everyone updated his or her targets, and the consensus now is that next year will continue to be a good year. The problem with that is the consensus now looks a bit too optimistic to me, and 2025 could be the year of correction, or at least some volatility. So if you haven't watched our Market Outlook 2025, I generally invite you to have a look at that space. Glenn, for example, from NFG Partners, with whom I discussed, thinks that 2025 should be a good year for investors, that the easing central bank policies around the world and the falling yields should help the US big technology rally to further broaden toward the non-technology pockets of the market and beyond the US, with Europe, for example, seen as a good buying opportunity, a good buy target for those betting that the European stocks will eventually converge with their US peers, and that partly because, their cyclical nature is favorable when global financial conditions ease, and partly also because the valuation gap between the two continents, between the US and Europe, just got too wide and is now calling for at least some convergence. But of course, well, stock picking for the Europeans will be key in my opinion, because look, the Stock 600 index did well between January and May this year, but then the index remained range bound for the rest of the year, with quite a marked sell-off that we saw in summer. The European Central Bank rate cuts this year certainly helped keeping the index in the upper Fibonacci range for a good part of this year, but only a handful of companies in Europe that supported the gains. Among them, well, we have Siemens, the German Siemens, eking out the best performance of the year in Europe. The banks did well as well, but the luxury stuff makers like Louis Vuitton, for example, the car makers and the big heavy names like Nestle and Novo Nordisk have done quite poorly throughout this year. Now you would say, I know that it's not very different than in the US, that just a few names shoulder the rally there as well, and then the rest is pretty much sleeping and flat. But in Europe, the overall economic growth and economic activity remains poor as well, which certainly pushes and will probably continue to push the European Central Bank to be a little bit more aggressive with the rate cut policy than the Fed. But still, the European Central Bank alone cannot solve the European problems, because here in Europe there is just too much regulation and therefore a bit too little innovation to compete with countries like the US and China, for example. There's still a war going on our continent, and now the political scene is also getting murky in the biggest European economies like France and Germany. So we will see what happens. We all hope that 2025 will bring peace to our continent, less regulation, and hopefully more cooperation among the European nations. But it looks like a wishful thinking at this stage. And while that positive divergence of the US economy was very much noticeable in the valuation of the US dollar this year, and that beyond the euro, because the US dollar index is, in fact, having its best year since 2015. The US dollar index is now consolidating its gains at the highest levels in more than 2 years, and could eventually continue to extend these gains on the back of the gradually less dovish Federal Reserve outlook for the US, and that based on the fact that the US economy did not weaken as much as it was expected to. We've been actually waiting for a recession in the US since more than a year now, and not only that the US economy is not giving any signs of recession, but it has grown by more than 3% last quarter versus 0.4% for the Eurozone economies. So the euro lost up to 6% against the greenback this year and up to 5% against sterling. Many investors out there think that the euro has more room to weaken against both currencies and could eventually eye parity against the US dollar. The pound, on the other hand, has had a good year, but a bad sell-off since September this year. But cable is preparing to close the year just 1% lower against a broadly stronger US dollar compared to where it started the year, while the dollar yen is behaving like its good old self. So the expectation that the Bank of Japan will eventually normalize its policy gives hope to the Japanese yen bulls. But the Bank of Japan remains short of these hawkish expectations. Then the Japanese yen gets sold. Then the Japanese authorities just step in to cool down the sell-off in the Japanese yen by a direct intervention in the FX markets. And then the BOJ also helps by saying that they will be tightening their policy, and then the cycle begins again. It's never enough. In commodities, gold has had a stellar year really, and can see more gains in case there is a sharp downside correction in global equity markets and in global risk assets, which is not the base case scenario, by the way, because the base case scenario is rotation from technology to non-technology names and from US to non-US stocks. While US crude, which trades past the 100-day moving average this morning for the very first time since October, will be probably closing the year in the bearish consolidation zone. That's below the $72.85 per barrel Fibonacci resistance as the expectation of an average 1 million barrel per day supply glut next year, and China's inability to reverse its economic weakness will probably limit the upside potential in crude oil. So this is all for this year. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode and all of the episodes this year have been helpful, insightful, and enjoyable for you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please do not forget to hit the like button on these videos to let us know that you enjoy them. So I will be off for a couple of days, and I will see you again next Tuesday. And until then, good day trading and a happy new year.